Hello financial fans, welcome back to another stock analysis. Today we'll be covering Starbucks Corporation stock ticker SBUX. Starbucks is a multinational coffee company and a coffeehouse chain. They purchase, roast and sell a variety of coffee beans as well as other products such as tea, pastries, sandwiches and other food items. The company also offers a range of beverages including coffee, tea and a variety of other beverages. Additionally, Starbucks operates and licenses a variety of retail locations, including standalone stores, grocery stores, and other retail sites. Starbucks also provides a rewards program for its customers as well as a mobile app for ordering and payment. Overall, Starbucks is a company that sells coffee and other products at its retail locations and also licenses its brands and products to other businesses. Currently, it has approximately 35,500 locations, and its market cap is sitting at $190.7 billion. In 2021, they generated a revenue of $32.2 billion, and their dividend yield is currently sitting at 2.03%. 61% of their revenue is generated from beverages, 18% from food, and 21% are others. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease, looking at the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in a scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from our margin of safety. The first two ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT has gone up, going from $2.2 billion in 2013 to $4.4 billion in 2022. The average growth in EBIT during this period was 20.7%, meaning a 10% deduction from our margin of safety. The margin has also seen an increase throughout the years, but it has calmed down again in 2022. It has gone from 14.8% in 2013 to 13.7% in 2022. Even though it is a decrease throughout these years, the average margin growth was still 7.8%, meaning a 5% deduction from our margin of safety. The next two ratios that we're going to look at are the dividend growth and the payout ratio. The dividends have gone from 96 cents a share annually to $2.12 a share annually. The average growth in dividends during this period was 11.1%, meaning a 10% deduction from our margin of safety. The payout ratio is sitting at a solid 69.2%, meaning no change in the margin of safety. The final two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Starbucks, this is almost 3.5 years, meaning a 354% debt to EBITDA ratio, meaning a 5% increase to the margin of safety. The return on invested capital for Starbucks is 13.2%, meaning another 5% deduction from the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Starbucks. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2015 to 2021. The average growth in cash flow during this period was 662%, mainly because of the COVID year, and the average then being messed up all because of it. Since we're calculating the lifetime expected growth up until 2030, for Starbucks I've gone with 12% in the future. With this percentage, we can determine the future free cash flow for Starbucks and determine a terminal year valuation using a perpetual growth rate of 2.5% and a discount rate of 8.5%. Then the sum of future free cash flow is $142.5 billion. To get our equity value, we have to add the cash and equivalents and subtract the debt. And then we're left with the equity value of $121.9 billion. All that's left to do then to get our discounted cash flow price per share is divided by the amount of shares outstanding, which for Starbucks is 1.1 billion shares. Doing this, we get a discounted cash flow price per share of $105.99. And with the current price of $104.26, this leaves a very tiny upside of $1.73, which is a 1.66% upside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth in dividends during this period was 10.17%. Since we're once again calculating lifetime expected growth rate in dividends, I'm going with 6.61%, which is 65% of this average growth rate. In this valuation model, we'll also once again be using a discount rate of 8.5%. Then, out of this model, we get a discount dividend model price per share of $119.80. And with the current price of $104.26, here we get an upside of $15.54, which is a 14.9% upside. The last model that we'll be using is the multiple valuation. By looking at companies that are similar to Starbucks, looking at their stock price and earnings per share, we can determine an average PE multiple in the industry. In this case, it's 28.92. Then all that's left to do to get our fair value is multiply it by the earnings per share that Starbucks is generating, which is $2.83 a share. This leaves us with a fair value of $81.85, and with once again the current price of $104.26, here we get a downside of $22.41, which is a 21.5% downside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, and multiple valuation prices per share. Out of this, we get an average of $102.55. The margin of safety we have determined earlier using a standard margin of safety of 25%, adding 5% because of the debt to EBITDA, deducting 10% for the EBIT growth, deducting 5% for the margin growth, deducting 5% for the return on invested capital, and deducting another 10% for the dividend growth. This leaves us with no margin of safety at all. So the fair value is the same as the average out of all of the valuation models, which is still $102.55. And with the current price of $104.26, we get a small downside of 1.64%. So in this case, it would be a sell, but let's just say it's very close near fair value right now. If there's any other companies that you would like to see on this channel next, please let me know in the comments. And thanks for watching.